As you know, I'm the President and CEO of the TAG Alliance, TAG Alliances. Thank you very much, everyone, for joining this webinar today. We have a unique webinar and experience for you, as a number of our UK-based members are going to present information today about the impact of Brexit globally. For most of you that don't know, this webinar arose following a meeting of the UK and Irish members in Belfast this past July. The meeting in Northern Ireland was convened with the intention of developing opportunities between our TAGLaw and TIAG members in the UK and Ireland. At the time, no one had really anticipated, although they maybe should have, that the Brexit vote would have gone the way it did on June the 23rd. As a result, the focus of the Belfast meeting was to discuss the opportunities that will likely arise from Brexit and how best to collaborate in order to take advantage of these opportunities. Obviously, the disruption caused by the Brexit vote is being felt globally. It impacts trade relations and trade opportunities throughout the world. But fortunately, we have a tremendous panel of experts today who are prepared to share their observation and insights on the impact of Brexit and the opportunities it presents to you and your clients. After this webinar, you'll receive an email containing a link to this recording, along with the presentation slides. We encourage you to share this content together with the numerous excellent articles from our members that have been posted already to our website with your clients and prospects in order to promote the expertise found within the TAG Alliances. Before we introduce the panelists, I'd like to let you know that you can be fully engaged and participate in today's webinar by asking questions. Use the WebEx chat feature at the bottom right hand of your WebEx screen. And in the interest of time, we will save the questions that you may have for the panelists until the end of the presentation. As I said, we've got an excellent panel, and the participants and topics for today's webinar include Robert Levy, Ian Morris, and Martin Lewis of our TAGLaw member firm in Manchester, England, Kuits Solicitors, who will provide an overview of the constitutional position from the UK perspective and the political options and likely outcomes of the negotiations. We also have Sean Farnell, who I believe is a supporter of the Leave campaign of our TIAG member firm Burgis Bullock in Warwickshire, England, who will discuss the various tax implications surrounding Brexit. Finally, Andrew Moore of our TAG strategic partner member firm Alexander Beard Group in England will discuss the Brexit effects on financial planning and various employment benefit and mobility issues. Before we get to the panelists, we're pleased to introduce Deirdre Kilroy of our TAGLaw member firm in Dublin, LK Shields, to provide some opening comments. And following Deirdre's comments, Jackie Smith from our TIAG member firm in Northern Ireland, G. McGee, will provide us with closing comments at the end of this presentation. Deirdre, thank you for being with us.
Thanks very much, Richard. So we're kicking off the webinar with a non-UK lawyer, and we're their next door neighbours, closest in law in terms of being the only other common law country that is a member state of the European Union. And we, along with many, were quite surprised by Brexit. Brexit being the shorthand way of saying that the UK is leaving the European Union. And it was a close-run referendum that brought us to this point. 52% voted to leave, 48% voted to stay, and there wasn't a uniform decision taken across the various countries that make up the EU. And now we find ourselves in a process of change, and I'm really looking forward to hearing the panelists take us through that, because change as lawyers, I suppose we're all familiar with it, but it brings opportunity, it also brings challenges, and I think this is relatively uncharted territory. Britain will be the first member state to leave the EU. Greenland did depart, but it wasn't a nation state. So in terms of the formality of what happens next, Brexit means Brexit, says the new Prime Minister, Mrs May, but we're not all certain about what that is going to mean. And indeed, the formal legal process, which I've just set up there on a screen in front of you, which will be of interest to you, is not yet kicked off. So we're really in a very initial stage of understanding what this is going to do to our practice generally and to our clients' businesses. The process following the referendum envisages an activation of a formal legal process whereby Britain will leave the European Union by issuing a notice pursuant to one of the EU treaties, and that is yet to happen. The indication from the British Prime Minister currently is that she won't start the process before the end of 2016, which is not really an indication of when she is going to start the process, but rather when she's not going to start the process. So it's still an open question about when exactly the EU will exit, but they do intend to negotiate the exit and currently are in preparations for that. As a lawyer practicing in a jurisdiction so close to the UK, where we have historical trading links and current trading links going back over centuries, the initial impact upon our practice and the businesses of our clients was, well, no surprise, it was surprise. And the currency fluctuation that occurred post-Brexit because of the uncertainty that it caused was the first impact that we observed. We also saw our clients deal with the uncertainty that an uncertain legal process and structure brings with it. Transactions and investments were postponed or are currently being assessed. Contract and other documentation which was in place recording relationships and structures now has to be reviewed because of the uncertain channels that the new structure will bring when Britain's relationship with the European Union is worked out. As a firm, we put together a Brexit committee. That is a committee that was put together in anticipation of what would happen. We didn't really believe that we would be active. Once Brexit was voted for, we began to, in earnest, examine what is going to happen for our clients and our colleagues, because relationships will inevitably change and we need to be ready for them. We need to monitor the statements coming from the European Union in relation to the negotiations with the United Kingdom, and also we need to monitor what plans European or the UK wish to take in terms of their exit strategy. And this is going to have an impact on our lawyers and group structures across our practice areas, and we really need to look at regulated market and industries in particular, because they're the most likely to receive the impact of Brexit. So in terms of my own practice, I'm an intellectual property and technology lawyer. I immediately saw some cross-border UK work halt or be suspended or terminated, and I also had to encounter queries from clients in relation to change of law, change of circumstances, clauses in contracts with UK companies that have terms envisaged to last for more than 2 years. We're currently under review or being renegotiated, and also as a data privacy lawyer, I need to consider the impact on data transfers in and out of our jurisdiction from the UK. And I do see it having an impact on our business. It's currently a lot of contingency planning, I think, drafting for changes, drafting in anticipation, and no one really knows what's going to happen. But we need to be ready as lawyers to make our best guess and follow the process closely so that we're best placed to advise our lawyers. And that's why TAGLaw is such a great structure, because we can share the information. So I'm really looking forward to hearing today from the panellists who seem an excellent bunch and seem to have really interesting perspectives to share with us. So I'll hand you over to our first panellist.
Hello everyone, this is Robert Levy from Kuits in Manchester. The 23rd of June 2016 event was cataclysmic in the UK. We joined what was then the Common Market in 1973, and 17.4 million people on a turnout of 72% decided on 23rd of June that our time in the EU was up. The first point to note, as Deirdre has quite rightly pointed out, is that the referendum was not the political step to trigger departure. To trigger departure, Article 50 of the Treaty of the EU, the Lisbon Treaty of 2009, has to be delivered by the UK government. That, on your screens now, is the offending article, and I think most UK lawyers believe that the trainees within their firms could have done a better job of drafting it. It's certainly not a tremendous work of drafting, but effectively it is only a procedural trigger. There is a debate raging in the UK at the moment. It's going through the UK courts as to whether the Prime Minister can serve Article 50 by Crown prerogative or whether legislation is required. It won't surprise you to know that it's the Remainers who wish the decision to be in favour of legislation in the belief that Parliament could actually block the Brexit process. I believe that is unlikely. The Article 50 provides a timetable whereby once it's served, exit has to be negotiated within 2 years. That period can only be extended by unanimity, and only the UK can serve notice. So until we serve notice, we remain a full member of the EU. The UK government will obviously be wanting to negotiate the terms of its exit in advance. The EU Commission are making it very plain that there will be no negotiations in advance, and at the moment the heads of state of the major European nations, in particular France and Germany, are saying likewise. So at the moment the UK is the spectre at the feast table in Europe, and will have seen in the last week alone indications that that is going to have an impact as France and Germany want to advance plans for an EU army, but the UK has no appetite for that and is suggesting that it will veto it. We still have our full rights of veto. So Article 50 will determine the terms of exit, not the new relationship. That will require a further treaty. What it will deal with is transitional matters, such as half-spent budgets, such as what happens to people already exercising freedom of movement in various member states. So if I can just move on to the next slide, which I can't do. Just a minute. Now, the question then is what possible models there will be in terms of our future relationship with the EU, assuming an Article 50 notice. And by the way, there are other possibilities. It is possible that we repeal the European Communities Act, effectively a unilateral withdrawal. Highly unlikely. The UK will not be breaching international law anytime soon. So the work needed to withdraw will be enormous. There's a huge body of EU-derived law. It's unlikely to be completed within the 2-year period. However, much can remain in place. The issue will be the laws that require mutuality, trade relations, passporting rights for financial institutions, or freedom of movement. What are the possible models we could follow? Well, we could follow the Norwegian model, where we come out of the EU, but we join the European Economic Area through the European Free Trade Association. That would give us access to the single market, freedom of movement of goods, people, services, and capital, but we'd have to pay a fee. Norway pays 300 million euros for the privilege. Our EU contribution in 2015 was 13 billion euros. We could follow the Swiss model, where we come out of the EU, we join the European Free Trade Association, but not the European Economic Area, and we have a load of bilateral arrangements. That would give us limited access to the single market. There would be potentially limited freedom of movement, but no agreement regarding financial services, unlikely to be attractive to the City of London, who require passporting. That's why Swiss banks need to have offices in EU member states to be able to conduct business, to avoid the need for further regulation. London at the moment doesn't have to have further regulation to sell financial services into Europe. The Canadian model, removal of customs duties, ending various other restrictions, but Canada, it took Canada 5 years to negotiate its deal, and it's expected 2 to 3 years to ratify. we could have our own bespoke arrangement. Would it be a hard Brexit where we just leave totally and we rely on World Trade Organization terms to continue trade with the EU, or a soft Brexit where we renegotiate with the EU? But we can see from the USA's attempts to negotiate TTIP that is an extremely difficult exercise. And we have a lack of trade deal negotiation in the UK in the public sector. We've not negotiated a trade deal since before 1973. So at the moment, we know that the government is scrabbling around in the private sector trying to get expertise in. So will we be out in the cold, or will we have the sunlit uplands that the Leave campaign promised us? Only one person will have the final say, and that will be Theresa May, the new Prime Minister who was appointed following David Cameron's hasty resignation. But Deirdre said, she says Brexit means Brexit. The only problem is we don't really know what that means.
Hello, everyone. I'm Ian Morris. I'm Head of Intellectual Property at Kuits. The key point which follows on from Robert's introduction is that there is a great deal of uncertainty, and particularly in the IP field, much will depend on the outcome of detailed trade negotiations. But it is likely that to maintain access in whole or in part to the single market, the UK will need to make concessions on movement of peoples and other keystone elements of the Union. My view is that if access to the single market is to be maintained in that way, then any concession on free movement is likely to be matched by not accepting any further restrictions on sovereignty. So most IP lawyers think we will not accept Commission rulings, or in particular, the authority of the Court of Justice of the European Union. So if the intellectual property regime depends on being subject to CJEU decisions, it is likely that the UK will be outside of that. Turning to my next slide, what does that mean in practice for businesses? Firstly, with trademarks. Businesses should continue to register and enforce their rights. The current regime is in place and will be until the negotiations are concluded. However, to take advantage of the community trademark, which operates throughout the Union, one has to be a member of the community. So we are likely to cease to be a member of the CTM regime. National marks should be applied for as well as community trademarks. We are advising clients to apply for both from now. Going forward, if we leave the Union, there may be automatic importation to the UK register of marks, which are currently covering both Europe and the UK. Or, to avoid clutter on the register, companies may have to demonstrate use in order to bring the mark onto the UK register. Another important aspect of trademark law is exhaustion of rights, which differs to Europe. To say in the US, and European trademark owners have additional rights to prevent, in particular, parallel imports. So if we cease to be a member of the Union, the position of parallel importers may improve. You will see that I've put up another slide saying a grandfather provision. What is that? It is a way of making all the existing law remain law in the UK post-Brexit. The fact is that the legislation, as Robert said, is enormously complex. So a simple way of doing it is to say the law stays as it is, but going forward, the UK will be free to adopt its own modifications and jurisprudence. In that context, specific rights are likely to be amended. My own view is, without a grandfathering provision, it will simply be impossible to complete the legislation needed on time. Turning now to patents. The European Patent Convention is not part of the European Union setup, so the UK's membership of that will be unaffected. But the proposed Unified Patent Court is unlikely to be ratified by the UK. There is some discussion at the moment whether it should be better in or out of the UPC. But if we are not part of the EU, it is better to be out. And a condition of the UPC is acceptance of the authority of the Court of Justice. However, in the patent field, Commission guidance and decisions of the enlarged Board of Appeal are likely to stay influential in the patent system because of our membership of the European Patent Convention. Turning now to copyright and designs. Copyright will be less affected. There are very few EU decisions on copyright, so the protection of artistic works, literature and music is likely to stay the same. However, the design regime will change. The community unregistered design right, which has a period of protection of 3 years, is likely to go. Some practitioners would like to see a UK equivalent of the CUDR. I doubt there will be time to enact this. Meanwhile, the UK's own rather specific design right protection of effectively 10 years will continue. However, what will need to be resolved is whether or not that will continue to be offered to the EU as an automatic protection for designs emanating from within the EU. Once again, that will depend on the outcome of the trade negotiations. In the registered design field, there will be a need for local and European registrations in a similar way to trademark. Competition. Martin Lewis is talking about this as well, but I believe there will be a political demand to loosen the judicial ties that are not necessary to implement a trade deal. Further, we'll detail competition negotiation with other countries, if necessary, particularly the US, seek to impose their own version of antitrust. There could easily be a conflict moving forward, which IP lawyers in the UK will help to resolve. So looking ahead, Sir Robin Jacob, a retired Lord Justice of Appeal and Professor of Law at University College London, has lectured and written extensively over the years on the advantages and disadvantages of the European system. Very simply, he tends to say it has been useful in terms of patent harmonization, but poor in understanding the real function of trademarks. So I can say that whatever the outcome is, I would expect the UK to plough a separate, and in some cases better path, once Brexit is confirmed. Thank you.
Hello, I'm Martin Lewis. I'm a partner in the commercial and IP team at Kites, and this is our final section looking really at the impact of Brexit on commercial contracts. Obviously, it's something which is pretty important to nearly any organisation on the basis that nearly everyone's got commercial contracts of some kind or other. And a lot of the questions we get from clients are where might they start in understanding some of the issues or some of the higher risk contracts that they may have as a consequence of Brexit. Our advice here really is to perhaps focus for now initially on those higher risk areas as we've identified on the slide, being contracts which supply goods and services into or within the EU, contracts which cover EU regulated sectors, and financial services of course is a very good example of that. Ian's talked about the intellectual property impact of some of the EU-wide property rights, community trademarks, community registered design, etc. And the other key area worth considering is the longer-term contracts that an organisation may have. Obviously, for this one we're talking about, if you have a short-term contract, it's unlikely to get affected by Brexit because, as we've identified in earlier slides, Brexit's unlikely to happen before 2.5, 3 years, and possibly longer. An important point to be aware of, though, is that during the period in which we've been members, the UK being members of the EU, during that time, almost none of the EU law has actually affected standard contract provisions in your average contract. So a lot of the changes which may occur are unlikely to unsettle existing contracts. However, that said, as a lawyer, I would say this general rule, but there's always some exceptions, and I've identified a couple of my top areas to consider as exceptions to that position. The key ones to look at are force majeure and frustration, change of law and regulatory regimes, and in particular continued compliance, and finally competition law, looking at that a slightly different angle to the one that Ian's already touched on. Firstly, force majeure and frustration. These are doctrines under English law which can sometimes successfully provide relief for parties from having to perform their existing contract obligations, excusing causes, essentially. And the question here is really, is the very impact of Brexit something that could be claimed as a potential force majeure or frustrating event preventing performance under a contract? If that's the case, what are the issues for clients? Well, if you're receiving goods and services in that contract and that's what occurs to you, then you may not get what you expected. Or similarly, if you're someone who's performing a contract, you may not be able to perform and may need to claim an excuse as a consequence, otherwise you'll be in breach. So our tips for things to do to clients at this stage, well, consider whether for any of your key contracts, high-risk contracts, does Brexit make it problematic for the other party to perform any of your material contracts where you're receiving goods, services, etc. Similarly, take advice if you yourselves might need to seek for force majeure or frustration relief yourself. And interestingly as well, when negotiating future contracts, we recommend that you clarify expressly in the contract whether the impact of Brexit will or will not qualify as such a force majeure event. Turning next to change of law and regulatory regime, particularly interesting here, of course, is for those contracts where, such as outsourcing, where you're relying on someone else to provide a service for you in compliance with the law, and as laws change over time, who's going to bear the risk of that compliance? Brexit, as we've touched on in various different angles so far, is likely to lead to changed laws in a number of areas over time, perhaps applying to contracted for services, goods, or perhaps software. Brexit may also well lead to the appointment of new UK regulators to replace our reliance on existing EU regulation, and they're likely to apply new rules, certainly in certain areas. So the key issue contractually here will be, I believe, who's going to pay for changes required under a long-term contract in order for the contract to stay compliant, stay legal. Also, for those sectors or types of service which require some kind of authorization or licensing, who will apply for those licenses and authorizations? Are they going to be something that's easy to achieve? Will there be costs involved, and who's going to bear those risks? Our advice here for things to do really are to check your existing and also your new contracts in these riskier areas, and ask yourselves a question really: are you still comfy with the legal regulatory compliance split of risk, given that we now know Brexit will happen, and I think a lot of people didn't expect it would when negotiating the contracts in the past? If you believe you can foresee some problems coming, we suggest it's worth an open conversation with the other side to consider whether the risks might need to be fairly reallocated, and if there's agreement on that, then I envisage that might look like a contract variation in order to make sure that the contracts you've got remain win-win and actually perform successfully. Of course, advice for nearly all of these points: make sure that we monitor future changes in laws, regulators and authorisations to ensure that we can stay compliant over time. My final section is competition law from a contractual angle. The context here again is a continuing theme of compliance both before and after the Brexit event. The context for UK businesses, well, trading businesses of any material size will need to comply and have needed to comply with competition law for a long period of time. This is particularly important for businesses which compete within or across the EU. Over time, the UK law has become heavily harmonised with the EU, and so we will start with a very, very similar position to the continental position following Brexit. Some issues really to note. Even after Brexit, the EU regime may well still apply to activities carried out by organisations if the EU considers that those activities might affect interstate trade within the EU. This is also the case, of course, for the US and other world competition regimes. If those regimes believe that activities under a contract outside their borders may affect their territory, they may well seize jurisdiction anyway and insist upon looking into the arrangements. As a consequence, Brexit isn't necessarily going to mean that UK companies only need to worry about the UK regime. They may well continue to have to comply with multiple regimes, including now the EU, at a slight distance from previously. The block exemptions, which have traditionally been granted in a whole range of different areas, IP, vertical agreements, etc., are likely to need to be replaced because previously organisations in the UK could rely on them. And it's possible that investigations can occur from both the UK and the EU authorities. That's not something that could happen currently. So things to do: consider the extent to which your activities will affect EU trade. Try and remain compliant now, but also watch out for changes or relaxations, and keep an eye out on change to make sure that you can stay up to date with the new regime. Thank you.
Thank you very much. Hi, everybody. I'm Sean Farnell, one of the partners here at Burgis Bullock Accountants and TIAG member based in Warwickshire in England. I've been asked to present on the potential tax implications of Brexit and put forward some business positives. As my co-presenters have already explained, at the moment this is a little bit like picking out next Friday's winning lottery numbers. Nobody really knows what's going to happen, and we're still in this sort of grace period before Theresa May invokes Article 50 and the hard work and negotiations start in earnest. With the uncertainty that's surrounding us, sometimes being asked, why did so many people in the UK vote for exit? And I think one of the reasons was that whilst there's uncertainty in coming out, there was an equal amount of uncertainty in actually staying in the EU. And I think a number of people sort of voted for a known unknown as opposed to the unknown unknown. However, I'll try and put some clarity around one or two of these issues for you. And we'll start with tax. And if we start with indirect tax and VAT in particular, VAT is probably the tax that's had the most headlines around it, if you like, since the Brexit vote, insofar as VAT was introduced entirely as a condition of us joining the European Economic Convention, the EEC, which is now the EU. However, whilst it's a condition of being part of the EU, it's highly unlikely that VAT would be scrapped when the UK leaves. It generates £120 billion per annum, so whilst some of the Brexiteers might be very excited about the elimination of VAT, I think being able to find 120 billion annual tax from other sources would be somewhat unpalatable to the electorate. So what can we say with some sort of certainty? Well, post-Brexit, the common EU VAT rules will no longer be binding on the UK. This has been a bone of contention in one or two sort of fairly high-profile areas over the years. I won't name any of them in particular, but it's certainly been an issue that's been in the press quite recently as well. We won't be able to rely on EU law for VAT rulings, and I'll come back to that one in a moment or two. What the UK will have, though, is the ability to set their own rates, and things like children's clothing, things like using the 0 rate, 5% rates, which are currently banned in certain circumstances by EU regulations, will then be free for the UK. However, of course, if selling to the EU, as my co-presenters have already said, will still be subject to the existing EU rules. So anybody who's exporting into the EU, those rules will pretty much remain the same, with the exception of the physical movement of goods, where at the moment we have a 0 rating policy whereby, provided if we're selling B2B, we can quote EU VAT number, not charge UK VAT, and the goods go over free of VAT. We just then have an internal EU reporting via Intrastat, EC sales lists, etc. That will all obviously go once Britain leaves the EU. So what will we be left with? Well, the answer is we don't really know. It's highly likely that there will be some form of import and export declarations needed, quite probable that importing from Europe into the UK and vice versa, there'll be import VAT payable at port. But again, we don't really know until the negotiations start. There's the probability, much in the same with other jurisdictions, that UK businesses trading in the EU may very well have to register in those EU countries separately. Again, that adds to the complexity and potentially adds to the cost in trading with Europe. And will there be customs duty imposed? Again, it's a difficult one really to ascertain. Depends who you talk to. Depends on what mood the EU leaders seem to be in at the moment. Customs duty isn't currently harmonised. It is a difficult one, but the fact remains that we are a net importer of goods from the EU, and I'll sort of come back to this point a little bit further down my list. Supply of services, unlikely to be vastly different, to be perfectly honest. The rules are unlikely to change significantly, although VATMOS, the mini one-stop shop, is again likely to be blocked. That will disappear more than likely when we leave the EU, which will mean that people trading services across the EU are likely to have to register for VAT in each individual country. Similarly, when incurring VAT costs within the EU for UK businesses, they'll no longer be able to reclaim those other than by application to the country in which the costs were incurred. And we know from past experience that can be very complex and take an awfully long time for anything to come through. And just to reflect back on the effect of EU rulings, recent EU ruling actually resulted in £150 million worth of rebates to members-only golf clubs. That was a direct result of an EU ruling on VAT. So there is potentially some quite significant changes for VAT, or at least the impact on the EU for VAT. But as I say, it's highly unlikely that it will be abolished or radically changed. So if you look at direct taxes, in a lot of respects, direct taxes are less likely to be affected in a material manner because these aren't expressly dealt with under EU treaties. That said, the UK also has a number of comprehensive double tax treaties, which basically prevents individuals or organisations being taxed twice on the same profit. And Brexit will actually have no impact on these agreements. So whilst there may well be changes to freedom of movement, there'll be less of a consequence in a lot of the tax fields than maybe we would otherwise think. On some specifics, in recent years there has been a number of UK direct tax proposals that have had to be modified or even curtailed as a result of falling foul of EU laws on state aid. So again, once Brexit happens, it's quite possible that some of these might well be reintroduced. There's been some aspects of the R&D, research and development tax relief, for example, and the patent box relief, although this did fall foul of the guidelines, so it's unlikely that will be reverted directly back. The other one, of course, to look at is for individuals, and we just don't know whether there'll be an impact on returning expats as well as people wishing to visit or migrate to other EU countries, and that's, again, something that seems to be getting quite a lot of press currently. Let's see if I can move my slide. There we go. Okay. There's a number of EU treaties which I've put on the screen here. I'm not going to read those out for you. You'll get copies of the slides later. The fact remains, though, that the actual impact of Brexit is likely to be fairly minimal on all of these because these have all been enshrined into domestic UK legislation. So to unpick them would be a fairly major exercise. Not saying that it couldn't happen, but just coming out of the EU wouldn't get rid of them completely. We've looked previously at the 4 EU main freedoms, but one that seems to have been overlooked, and particularly when we talk about tax, is the issue of social security. And the EU currently has a coordination of social security systems so that as an individual, you only pay social security in one member state, so effectively you're not being taxed twice. That will obviously be lost once the UK leaves the EU. And that then gives us the very real possibility of people being taxed or taxed social security, both in the EU and in the UK, whether that's UK nationals working abroad or EU nationals working here in the UK. Now, whilst there are a few bilateral social security treaties, these really are very few and far between and very uneven in scope. So even those that exist are likely to need to be readdressed. And I think there's quite a lot of work there that maybe most commentators haven't sort of thought of yet. Okay, so the other, just sort of again on a taxation point of view, really the definitions of business size from micro, small and medium-sized entities, these are all very much driven by EU directives. And in fact, we fairly recently changed our classification here in the UK to comply with those EU directives. Now, again, I would guess in short term this isn't going to change, but over time we might want to change those. We might want to increase or reduce those definitions, which can have profound effects on accounting treatment for profits and taxation potentially here in the UK. One that you may well have heard of was that George Osborne, the then Chancellor, stood up in Parliament shortly after the 23rd of June and announced that he was going to cut the corporation tax to 15% to help encourage inward investment post-Brexit. Now, that would have been quite a move from our current 20% just to come down to 19%. Interestingly, though, the new Chancellor has actually said he's not going to do that. We've already committed to getting the corporation tax rate down to 17%, and he's quite happy to keep it at 17%. Out of interest, really, the EU average is 22.9%. That ranges from 33% in Belgium and France right the way down to 10% in Hungary and Bulgaria. So there's quite a large differential within corporate tax rates across the EU as it stands. So whether the UK cut to 17 or 15% is a moot point, really, I think, in that greater context, although it's politically it obviously makes a good headline here in the UK. So I think if I I can just move this on. There we go. Oh yes, this is another interesting point, and this is sort of one for our legal colleagues as well. Increasingly, EU law has been used to challenge UK legislation and UK tax laws, whether that's been due to quite often it's human rights challenges, for example. So obviously the supremacy of the EU courts will finish once the UK finally does leave. And there's actually concern that the UK government will attempt to withdraw the ability to bring a claim based on EU grounds, even though EU law would have applied at the relevant time. So, even though today we're part of the EU and EU law would be the primary law, in 3 or 4 years' time, once we're fully out of the EU, will the government go back and say, no, you can't make claims related to 2016? Now, you might think that might not be possible. The government does have previous on this, particularly when talking about tax legislation and changing the rules. Not retrospectively, they call it retroactively, but it amounts to the same thing for me. And obviously, once we're out of the EU, any EU laws or treaties that prevent additional new taxes, a fair game, really. So again, whether we bring in new insurance taxes or turnover-based taxes is, again, a moot point. So what about the business potential or the business positives? Okay, again, we're in this sort of Cinderella period where since the Brexit vote, yes, sterling did go down, and it went down fairly significantly on the 24th of June. But since then, it's rallied a little bit. It's still not anywhere near where it was at the start of June. But just to put it in context, it currently sits at the same value against the euro as it did in August 2013. So, this hasn't been the worst thing since sliced bread, really. We're down quite considerably against the dollar. Jan 2009 was the last time we were down this low against the dollar. But obviously the spin-off is, for UK business, that's made their exports much more affordable. And we've got a number of export clients who are literally making hay while the sun shines and trying to lock themselves into long-term currency deals at the current rates. A potentially unexpected spin-off of the change in sterling was tourism, and we've seen an 18% increase in overseas visitors to the UK since the 23rd of June, which is quite a significant change. Obviously, the UK is now a lot cheaper for foreign visitors, and a 21% increase in staycations. These are people who live in the UK, who are going to go to holiday in the UK, who might otherwise have gone to Europe for their holidays. And with Europe now being significantly more expensive than it was before the vote, a number of these people have stayed in the UK, which has been great for our internal economy. And I've rather flippantly put not the euro there. I'll sort of come back to that one, I think, on the next point. So the second one is seen as being a positive by a lot of people, is that the UK then becomes an independent market. We're no longer tied to the apron strings of the EU. The UK economy is growing at twice the rate of the EU economy. It's very positive, and we had the chief economist of the ONS, Office for National Statistics, this morning saying that the Brexit vote hasn't had any impact whatsoever on the UK economy over the last, where are we now, two and a half months. The fact remains that there is a bigger world out there than just the EU, and a lot of the Remainers have obviously focused on the EU as being our major trading partner, which they are, and they will always be our nearest trading partner, but there are a lot more countries out there than just the EU 27. And leaving gives us the freedom to negotiate our own trade deals. Interestingly, in the short period since the Brexit vote, we've had 27 countries have already applied to start negotiations. Now, as was mentioned previously, until Article 50 negotiations have been completed, I think we're actually precluded from having official trade negotiations with anybody outside the EU unless it's run by the EU. But I wouldn't be at all surprised that within a couple of months of us leaving the EU, there are a number of these countries trade deals formally signed that were obviously in the embryonic stage, shall we say, before Article 50 has run its course. Also, to pick up on the point of us not having any trade negotiators, which is a very valid point, there are 2 or 3 countries, I think Australia and New Zealand are certainly 2 of them, that have actually offered to lend us their trade negotiation teams to help us in that process. I'm guessing that's not an entirely charitable offer. I guess that would mean that they'll also be top of the list when it comes to prioritising who we speak to first, but that could be quite interesting negotiating with themselves, I guess. Again, on that point, the speed of negotiation should be massively quicker from the UK perspective when dealing with countries outside of the EU. When dealing with the EU, I accept we've still got 27 countries to deal with effectively, each one of which has a veto. But when dealing with, if we took the American example, and TTIP was mentioned a while ago, which I think so far has taken something like 9.5 years to negotiate, and everybody now seems to feel is a bit of a dead duck. That's partly because you need unanimity from 28 countries within the EU to negotiate a deal with the US. One-on-one should be a lot easier, it should be a lot simpler. There is the risk of the EU imposing barriers and tariffs, as I mentioned before when we looked at customs duty, although, as I said, we actually have an 80 billion trade deficit with the EU. So, again, a lot of people are sort of asking the question, it's all very well talking tough, but would the French, would the Germans in particular, really want to risk damaging their own agricultural, engineering, manufacturing trade businesses by introducing trade tariffs? Because there would be a tit for tat, there's no two ways about it. Independent market, again, can the EU control pressure from its weaker economies in the euro? You know, the southern European economies are struggling. The stresses on the euro, I think, are well known around the world. And obviously, if the euro sort of disintegrated, then this would have a major, major shock on all of the EU economies. And there is a school of thought that the UK would actually be better off outside if that's likely to happen. Last few points for you then. Immigration, is this a positive? Actually, it is a positive. The UK needs immigrants. It always has done. We have an ageing population, a skills shortage. We've always relied on immigration. But the second point there is control is the key. And really what coming out of the EU it potentially gives the UK is an ability to better pick who, with what skills, for how long, what areas can actually come into the country, rather than just having complete mass immigration of anybody from Europe who wants to jump on a ferry or jump on a train. Particularly this is seen as opening up the Commonwealth countries. We currently have very strict quotas placed on Commonwealth countries' immigrants, and I think historically the UK has an obligation to a lot of our former Commonwealth partners. There is a question there, will this push up costs? And I think the general perceived wisdom is in the short term, yes, at the low end, this may very well push up some business costs for business. Less red tape is one that everybody's talked about, but nobody really can ever quite put their finger on exactly what EU regulations would go, exactly what the restrictions on SMEs would be released. But again, that's commonly seen as an advantage. UK property just got a lot cheaper because of the exchange rate movements, and we've certainly seen that across the City of London. I know that there's been a lot of interest again from foreign investors coming in, quite the opposite of what we were told pre-Brexit. And finally, another business positive here in the UK, it gives us the possibility to revive some of our lost industries, particularly the UK fishing industry, and there was a big Brexit vote around the fishing ports. Ending of EU state aid rules, so again, if we needed to step in and support, whether it's the steel workers or any of those other big industries, it gives us the opportunity to do that and potentially nationalise, should we want to, without having to go to EU. So, as I say, it's very much like trying to pick the numbers for this weekend's lottery, but hopefully I've given you a little bit of a flavour of some of the potential tax and business implications. Thank you.
Hello, my name's Andrew Moore, Director at Alexander Beard. Thank you, Sean, for a very interesting presentation covering a lot of the economic issues. So I'll make my presentation slightly shorter as a result, but I will make sure that I ask you for your lottery number tips for this weekend. You seem to have a very good handle on things. Now, what I'd like to cover is the investment aspects, the implications of Brexit on investments, pension funds in the UK, and also on the sale of financial services or financial products into Europe. So looking initially at the immediate considerations post-Brexit, as has been well covered already, we saw a decline in the value of sterling. This did support export competitiveness, but perhaps not as universally as you might expect. The UK not being quite so rich in natural resources, it did actually result in increasing the price of certain components and basic materials to build the products to then be exported. But overall, there certainly was a rise in export business. Also, overseas buyers, I suppose, snapping up relatively cheap UK property, certainly has helped prop up the UK residential property market. And I think there might be some evidence as well of some potential buyers delaying their decision until we have clarity on the decision with regard to EU membership. With regard to commercial property, there was a slightly higher risk, and there was some evidence of panic selling of investments in commercial property investment funds. Now, when that happens and the investment funds are potentially forced to sell buildings in order to raise cash to pay investors, the doors can close, and in fact most of the UK commercial property funds actually ceased trading for a period of 6 weeks or 2 months, and we're just now seeing evidence that that period is coming to an end, and these funds are now open again for business as the panic seems to have passed relatively quickly. Tourism as well was up again, the weaker pound, and that's good to see, and staycations are up as well. With regard to the stock markets, there was a brief and sharp reaction in the main markets, down between 10 and 20% in the UK, US and across Europe, but not all markets were particularly affected strongly, and in fact some of the emerging markets came out quite publicly and said we're completely unaffected by this decision. So there was a brief reaction in markets, but they seem to have recovered values quite swiftly and in fact gone through the pre-Brexit levels, broadly reflecting a general sort of global economic recovery. Another interesting aspect is when there is uncertainty, there does tend to be a rush to safety. And the rush to safety translates into the buying of UK government bonds, also known as gilts. And so what we saw was actually quite a sharp increase in the price of gilts, up about 15%. This was further supported by the central bank, the Bank of England, reducing interest rates. So when the base rate is lower and the interest rates available on savings accounts are low, it does tend to push more investment money towards government bonds as the kind of next level up in risk and potential interest rate payments. And we had a brief period where yields were negative. And I will explain the significance of that in a moment. The other investments that seemed to increase in value were overseas investments. So UK investors that hold a diversified portfolio would generally have some UK stock markets, some overseas stock markets, and various bonds, including government bonds. And whilst we did see a bit of a sharp decline in stock markets, the overseas stock markets, the impact was not felt so greatly in the UK because of the fall of sterling. So whilst the market was down, the number of pounds in terms of value remained broadly the same. The net effect of all of that is that we actually saw quite a reasonable increase in the value of investment portfolios over the last quarter. Now, I'd like to cover the impact on UK pension schemes, and in particular, a lot of these comments are focused towards defined benefit schemes. So these are pension schemes that they're less popular these days with employers, but nonetheless there are some 7 million people in the UK that are members of these schemes. And these are schemes where the amount of pension income that you receive in retirement is a promise, effectively, from the scheme based on your period of service and your level of remuneration. So working really on guarantees. And the big question is how those guarantees or how those promises are supported within the schemes. Now, as I mentioned, the value of gilts rose quite sharply following the referendum. Gilts are often used to provide income. So if you have someone retiring at age 65 who's expected to live broadly 20 years, one of the safest ways of making sure that that income is paid is to buy a government bond with a 20-year duration and you know the interest that will be payable from that bond. This rise in the value of gilts also had a kind of reverse effect, and that's because gilts pay generally a fixed rate of interest. So if you buy a gilt for £100 and it pays you £4 interest every year, it's a yield of 4%. If the value of that gilt then goes up to £200, the interest payable remains at £4. It doesn't double like the value has. So in fact, the yield, or the interest payable, halves. Now, when schemes are trying to work out whether they have sufficient assets to meet all of their future liabilities, one of the metrics that they use to assess that is the yield on government bonds. And if the yield drops, it means that they need to bolster the level of assets in order to meet their future liabilities. So what we found was that schemes may have difficulty maintaining their funding levels, and at the same time, for individual members of schemes who ask to transfer out, we are seeing some higher transfer values, values increasing by something like 10 to 20% over the last few months is not uncommon. So on to the risks of Brexit. Overall, I think it's too early to say. There was some very stark warnings, in particular from Mark Carney, the head of the Monetary Policy Committee of the Bank of England, who was called in front of the Treasury Select Committee to explain why his outlook had been so pessimistic, whereas in fact, as the ONS information, the Office of National Statistics, shows that there hasn't really been an impact. And Mark Carney's response was that he was quite serene about the risks that he highlighted, principally because it's far too early to say. We really need to see what happens once Article 50 has been triggered, and only then will we find out the true extent. But I think what we have at the moment, which my fellow presenter Sean Farnell described as a Cinderella period, we're still fully fledged members of the EU, and this is the opportunity really to decide how we want to shape that exit. And as Robert Levy has covered, there are a number of different models that we could follow, examples set by countries like Norway and Switzerland and Turkey and Canada, but we don't know the precise shape yet, and it could well be that there's something particularly bespoke for the UK, that it's different to other countries. Ultimately, we fall back on the World Trade Organization rules, where we can continue trade but with tariffs. If I can move on to the implications for financial services, just move on to the next slide there. Passporting. Passporting allows the sale of financial products and services into European states without having to have a physical presence in that state. And prior to the referendum, there was particular concern that the loss of passporting rights would damage the City of London in particular. And the financial services industry is quite valuable to the UK economy. Overall, it accounts for about 15% of total trade, 10% directly, and 5% is in related industries. A recent report from Moody's suggested that the impact of losing passporting rights might not be so great, but the process of having to change and adapt within financial services companies will result in a short-term cost and a bit of a slowdown. It's an interesting point, this, because one of the biggest challenges in business is the allocation of capital and resources, and in the short term that will get harder for financial services companies, and some firms will do a better job of it than others. There's also evidence of some firms relocating jobs into the EU particular functions that interact with European states may well start to be performed in other financial centres such as Paris and Frankfurt. With regard to UK financial advisors, we really don't know what the situation is going to be at all. We have to see how the negotiations progress. Much will be down to regulatory decisions and whether the UK still remains part of MiFID II, the Markets in Financial Instruments Directive. We have to see how that works out. But I think one comment that I have on passporting of financial products, in particular in relation to retail investment advice, individuals, whilst it's a tremendous idea to be able to provide products and services into other countries, many financial services products are in fact closely linked to fiscal policy, to taxation. Things such as individual savings accounts or ISAs are tax-free in the UK, but the same rules don't apply in other countries. So a true open border provision of retail financial advice to individual consumers is very difficult to achieve until you have harmony on taxation. So the question of passporting, I think, is quite open. There's a view that it may not have much impact to lose passports, and at the same time, losing the passports could actually have more of an impact on individual advice for people who are already resident in Europe. But I do look after a number of individual clients who are French citizens in particular, and I'll declare my colours. I did vote to remain as part of Europe. I spent the first couple of days apologising to my French clients for the conduct of my nation, a position I never thought I'd find myself in. But I think having seen how the UK government has reacted, how global markets have reacted, I think there are many reasons to be positive, and the opportunities in the future really come down to how well we handle this change. But I think, as one of my fellow presenters has already commented today, change in itself can bring opportunities. Thank you.
I'm Jackie Smith, partner in GMACG Belfast. First of all, can I thank Richard Atisha for setting up this webinar, which, as he mentioned earlier, was first mentioned at a meeting here in Belfast among just a few of us. The webinar has had excellent content, and I certainly have found it very helpful, both on legal and accounting issues. I think we should also thank Deirdre, Robert, Ian, Martin, Sean and Andrew for the effort they've put in to make this a very successful webinar. Some of the words used today, if I could just pick a few. Deirdre mentioned the word surprised, the result. Robert said that the result had been cataclysmic. Sean, who is a true Brexiteer, said that nobody knows what's going to happen, which I think is true. Andrew said that panic has retreated relatively quickly. So if you take those words together, I think it's fairly clear that we're all unsure what is happening and how it's going to pan out. It is very, very early days yet. But if I could just make a few comments on perhaps a more macro view, maybe and throw in a little political comment here and there. Robert has already mentioned that Article 50 has not yet been triggered, but we do know that we have at least three main issues to contend with. First issue is we have the economic consequences of leaving. We have already heard that international companies such as Hitachi and some major US banks who saw the UK as their gateway to Europe are actually considering relocating from the UK to a European destination. And I think we need to wonder how many more companies and industries may follow and what might be the impact of that on our economy. I think much of the impact will depend on the strength of the UK negotiating hand, but I think we also need to realise that the UK is very much smaller than Europe, and it is hard to see, from my point of view anyway, how the outcome will be favourable to the UK. I know Sean and I would have a difference of opinion, and we have discussed that at some length. Secondly, I think there are a few geopolitical considerations that are really quite a critical issue. I think we need to remember that the European Union was born out of a need to shape a peaceful post-war Europe, and inherent in the European Union are complex networks and institutions that have all contributed to a long-lasting era of trust and stability that we just cannot lose. So new trade agreements and the negotiation of those agreements are essential. I think the final issue is the question of how the rest of Europe will react. And we have to ask the question, will there be further departures from the Union or demands to renegotiate new and better deals, which may in turn bring even more work for us as professional advisors? So, in reality, what price a diluted Europe, both economically and politically? As accountants and lawyers, we can't influence many of these issues, but what we can do is to remain on top of developments and agreements as they arise, and we need to advise our clients at the earliest possible date, actual or indeed potential legal and accounting implications possibly affecting their businesses. It's my understanding anyway that while new trade agreements with Europe will obviously be put in place, the UK is being advised to focus on the US and China in particular for new post-Brexit trade deals. In other words, companies are being recommended to spread their trading portfolio. And we need to be alive to these requirements and advise accordingly. There's uncertainty in the M&A markets, and clients will need advice on where to go from here. The term Brexiters has already been coined to reflect the potential for key employees, some say frantically looking for jobs abroad. If these do happen, restructuring advice will be required, and we all need to be at the forefront to service client demands. That all may sound a little bit negative, but the points are realities. But what also is reality is that the UK is a strong and growing economy at present, and there will be many opportunities to help our clients, no matter what the impact of Brexit. Everyone in this webinar has seen the effects and indeed the opportunities that arise during and post a recession. So Brexit is going to bring its own opportunities in a new and in a renegotiated environment where our clients will invest, grow and find new trading partners, probably on a more worldwide basis than ever before. And as someone mentioned earlier, we should remember that the UK hasn't struck a trade deal on its own since the early 1970s, and professional advice is going to be essential. So personally, I think that is the real opportunity for TAG Alliances. We are a top-class worldwide organisation, and I think we work best when we're working together. So personally, I look forward to even more of those opportunities, hopefully in the not-too-distant future, as a direct consequence of the Brexit decision. So I think maybe back to you, Richard.
Okay, well, thank you, Jackie, for that. And I want to thank everyone on the panel for your excellent insights and observations on the current impact of Brexit. I'm quite impressed that we've finished perfectly on time. I know the tremendous amount of preparation that went into this webinar, and I thank you all for the efforts you've made on behalf of everybody. As far as questions are concerned, I think because of the interest of time, if you have any questions, you can direct it to the panelists either by contacting them directly or sending them questions, and I'm sure they'll be pleased to answer them. We'd also like everybody to know that we will be holding a plenary session a follow-up on the status of Brexit at our international conference in Paris in May 2017, when more will obviously be known about the status of and the UK position at that time. And it's also clearly going to be an important topic of discussion in Washington, D.C. Next month, and hopefully we'll see most of you there at that conference. One quick reminder is we do have a webinar next month. We don't have a webinar next month because we'll be holding our Fall International Conference in Washington, D.C., as you know, from October 24th to the 26th. And if you haven't registered for that conference yet, I implore you to do so now. It's still not too late to attend, although it's fairly booked up and we have tremendous attendance for that conference. So I thank everybody for joining us today, and hope you all have I guess in the UK and Europe and anywhere else, a pleasant evening, and for everybody on this side of the water, a very good day. Thank you very much.